Welcome back to the podcast, everyone. Today, I'm excited to chat with Oliver Schmäschke from T.Capital, the strategic investment arm of Deutsche Telekom, managing over 2.3 billion euro in assets to back the next generation of transformative tech companies. Jeppe, I'm thankful that you've connected me to Oliver because he's quite the capacity. Oliver brings, of course, deep expertise in corporate venturing, helping innovative startups in areas like enterprise software and beyond scale faster through strategic capital, market access, and powerful partnerships from one of the world's leading telecom giants. Today, we'll uncover Oliver's 3 core principles for building a CVC that lasts more than the infamous 3.7 years that the average CVC lasts.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Oliver, welcome to the podcast.
Awesome. Andreas, thanks for having me.
All right. Yeah, but could you just tell everyone why you thought we should bring Oliver on for the podcast?
For sure. It's not that often you come across guys or persons in general that are not talking about how great they are. But when you open the discussion with them and talk and get your own points across, they listen and they have the same opinion. So I think, Oliver and I, we're very opinionated about corporate venturing and how you use this as a strategic tool. And that is not often that I have those conversations. So meeting Oliver in Hamburg is fantastic, and I'm really looking forward to these next good 30 to 40 minutes with Oliver sharing, everything about his view on corporate venturing.
Thank you. You see me blushing.
Oliver, I think there's no other way to do this than ask you to share your story, because it is quite one. And of course, T.Capital is not just T.Capital, but a little more than that.
I mean, where do I start? I mean, let's start with myself. I grew up basically in the volleyball gym, playing all day. Then at some point, decided to become a material scientist for whatever reason. Decided that's not a good idea. Joined Boston Consulting Group as a consultant, and then became the first employee at what is today T.Capital and DTCP. T.Capital today is a 2.3 billion investment arm of Deutsche Telekom, with a very clear, and we'll get into that into a second, with a very clear strategic mandate to propagate innovation, business, everything good for Deutsche Telekom. And doing that in a very, I'd say, we try to do it in the best way possible for a corporation, and I'm sure we'll discuss that there are certain elements on how to do it right or better and make the journey to work with a corporation easy for young companies.
Oliver, we are going to dive into your core 3 principles for building a CVC that lasts. Could you share in more detail how you've ended up to look the way you are today? Because it's quite a journey you've been on with T.Capital. So unveiled as much as you're willing to.
So the core part here is that you need to be very, very clear on what you're doing and why you're doing that. So from the get-go, it was always clear there's a distinction between investing for strategic reasons and investing for financial reasons. This then leads you to making different processes, different targets, different investment strategies that fit into that ultimate goal. So that's something we implemented at T.Capital very well, shedding the ambition to be the best financial investor out there. There's plenty of very big names there, but just become the best strategic investor out there. That's difficult enough, and it's a place that is needed in the world. Does the world need another great financial investor? Yes, for everyone, that's great if they do that, but that's not necessarily the role that we see for corporation. The objective of the corporation is to be the best telecommunications and AI and technology company out there. And how can we, as the investment arm of Deutsche Telekom, support that goal through smart investments into great companies that do great business together with Deutsche Telekom? If we turn a 10 million investment to 20 million or 30 million, that's great. But Deutsche Telekom, I mean, it's over 100 billion of value that's going around there. So it doesn't really move the needle. But if we bring a lot of innovation into the organization, innovate the products with the help of our investments, then we can really move something.
I think one of the things that we normally, when we talk about corporate venturing and this average lifetime of 3.7 years, right, is the risk of being closed down. I used to use this phrase by Ilya Strebulev out of Stanford that when you have survived 3 CEOs, you have a successful corporate venture entity. But a little bit back to what you're saying, it's a strategic tool, right? But what KPIs are you then monitored on, right? If it's not financial performance.
Yeah, I mean, so first of all, financial performance is important. No one is in the game of losing money. And it's very good if you can go to the CFO and tell him, look, whatever we're doing, we're not costing you any money. In fact, we're bringing more money back than you give to us. That's always a hygiene criterion. But then beyond that, it's obviously very important that the innovation leads or the business owners at Deutsche Telekom have a benefit from what we're doing. So whenever we do an investment, we do it alongside a business owner. He brings the rationale. We're working together with him to figure out how can this investment help you in doing business with this company through joint go-to-market, through using their products, whatever the constellation might be. And that's then also what you measure. How much did I help the business owner? And this can be from satisfaction and how smart he got, up until very hard KPIs like, did I meet my revenues that I was planning to do together with these companies? How many people are using this? Do I have the right customer satisfaction score in my application? Whatever it might be, depending on the investment.
Have you at Deutsche Telekom installed any kind of reward system for these business unit owners to work with you, right? Because normally in corporate life, you have like 25 KPIs a year you need to adhere to. But how do you make these collaborations successful from a corporate angle?
No, we don't. So the motivation to work with us for the business owners comes indirectly. So first of all, the budget comes from headquarters. So it's basically a free ride to draw on this investment capital. Two is we know the people for a long time, so they know that we are working together and together we create good things. And three, everyone wants to do new business and everyone likes engaging with young companies. So it's a very grateful topic to be around when you have 4 of your 5 days filled with meeting your quarter end numbers or thinking about the last restructuring, how do I make efficiencies, have some time with us looking into new companies, into young companies, new topics, new initiatives. That's typically something the business owners appreciate.
Now let me go to my big topic too. So to say, I know that there's few that have been as successful in building out a strategic venture unit as you have. So I'd love to understand from your 3 core principles for building a CVC that lasts.
You need to be crystal clear on what you want to achieve. Either you're strategic or you're financial. Most of the models I've seen failing after the famous 3.7 years or earlier is somewhere where it's like, yeah, we're somehow both, right? Which typically means you're neither of the two. And for a corporation, I think the better choice is not to be the better financial investor, because you'll be in competition with the very big financial players out there who can pay better, attract better talent, have more degrees of freedom. But you have a playing field that is obviously for corporation. You can be the best strategic investor out there. You can be very easy to deal with. You can bring more value to the company than a typical VC can do. And that's really, once you're clear on that mission, then you can derive the next steps. Which the second point then is that you have the right playing field selected. You need to be able to work with the right company subset that is relevant to you. So where do you find the companies or the funds that really share the mission of whatever your company or your corporation stands for? For us, for example, it means the companies need to be mature enough. Deutsche Telekom is a very, very large organization. So better work with companies that already have 5 million plus of revenues, Series B upwards, which just makes it easier to digest this very big organization with its processes. It's very important that you're not the biggest fish on the cap table as a corporation, because, well, then the company is over-relying on you. Also, if you're more than 50% of their revenue, that's typically not a healthy situation for a company. So that really narrows down the world of where you want to play. And then last but not least, the companies you work with, they have to like you, right? No one is waiting for you. So you need to invest into the relationship and really show both through your business as well as to the company of how to create value together. And if people don't like that and are only after your money because they don't get it elsewhere, it's not a good place to start. So rather I go to very good companies who don't actually need our money, but basically we can then use the investment to facilitate great partnership among the two. And then 3, obviously your structure and your governance needs to follow that. So if you're financial, well, there's carried interest, there is very independent decision-making, there's incentives for the teams. It's all tailored towards making as much profit as possible, which is great. But if you're a strategic investor, well, you need to have a different governance. There's a corporation that needs to be involved in the right way. You need to set the incentives so that it is in line with making strategic impact. And if you do that right and draw the right conclusions from that, then I think you're good in the race to become older than 3.7 years, because then you will also survive a CEO change or a senior management change within our organization.
So Oliver, you have been in the industry for so long, right? So you have also seen some of the cycles that are there, right? So when I listen to the three pillars that you have there, where have it been most difficult for you to get it right?
We were very lucky because Deutsche Telekom draws from a lot of experience. They have been investing in venture capital since 1997. So they were also one of the first to do this. All we did in 2015 or 2013 to 2015 when we made or thought about the structure is to look at what worked well and what needed to be changed. And I think this clarity of strategic versus financial is something you need to get right. And where it then becomes tricky, and Deutsche Telekom is in a very privileged position there because it is a very strong brand. It is a very large organization. So how do you get the right talent? You need to get that right. You need to attract people. And if you're a small corporation somewhere outside of a big city, it's not that easy to attract the right kind of talent. We're sitting in Hamburg and in Berlin and in London and in Frankfurt. We have Deutsche Telekom with T-Mobile has a great brand also, not only in Germany, but also in the US and globally. So that makes it already easier for us, but still it's very difficult to attract that talent and also then to retain that talent. Because obviously, and I have that in my team as well, there's people who are very, very talented, and then some of the bigger VC firms are coming along and can pay a lot of money to poach them. So you really need to find those people who have that investor gene, but also love working with the corporation. If they're only after the money, great for them, and then they go on to a financial VC at some point because they can earn money, carried interest. That's great, that's awesome, I'm all for it. But if you find those people who love working with the organization, who love creating value, sitting in the board with the company and not only telling them, oh, you need to meet your quarter end numbers. No, here's how I can help you in meeting those numbers. Here's how I can help make an introduction. Here's how I can help make business with Deutsche Telekom. That's where you find the right people and get the talent right.
Yeah, and it's such a special breed, I would say, having worked both in venture capital and in corporate venture capital, finding the mix of the two is kind of like finding a hidden gem, right? So, what have you done? What have you done, and do you do something special with your team, right? Because in venture capital, you're basically just left by yourself, right? Either you make it or not, right? You need to find the next unicorn, or you're left out there. Do you have any special tricks that you can share?
I think what worked well for us is to grow our talent. We have, especially on the venture team, we have a very young team, very talented team, and you can really build them up and build them up relatively quickly because they get to do more, or they carry more responsibility as compared to being in a VC firm, for example, relatively quickly. And you can really have them grow into what they're doing, have them adapt their playbook of how they attract a deal or get access to a deal. And you can really grow it into that. So that for us was more effective than lateral hires.
Oftentimes, I have seen CVCs hire out of the VC crowd, or at least try to. Have you ever done that? When you've seen it done, what are you how do you diligence that they would fit into a corporate? Can you talk a bit about that? Is it a complete no-no, or are there ways that you can ensure that you can do it? Because it is a very natural thing to do.
I mean, you can only speak broad average, right? There will always be individual cases where it differs. But the general perspective that I have there, I rather take someone who's younger or come from somewhere else, who aspires or basically sees this as a step up. This is great. I get to do investments in a corporate setting. That's awesome. I want that. As opposed to someone who's on VC and maybe is doing okay, but if he would be on a rocket ship to partner level with a lot of carry and a great fund performance coming his way, why should he go anywhere else, right? So naturally, the people who then I could hire from VC into CVC are in many cases the people who have not worked out perfectly. This can be that they were just in the wrong setting, and in CVC they will flourish. Yes, that's what I said. you'd have to look at the individual case. But I don't want CVC or my team to be someone where I take up the people who failed in VC and now need something to spend the next 10 years on, right? That's not what we're aspiring here. We have a team of highly motivated young people. If you go to our website, look at them. It's an awesome team, right? They're all on their way up. So everyone that we want to hire, for them, this should be a way up.
Let me ask you a thing on one of your questions or one of your statements, because you said for a corporation, the focus often needs to be strategic, because there will always be financial investors out there that aren't bound by the same things as you are as a corporate. Can you talk a bit to the competitive edge that a corporate does have? Because I know what you mean, but it could sound like you think that a financial investor will be better necessarily and will win out, but they will not. Like, they might have better returns purely, but that doesn't mean that they will be a better investor for a startup, as an example.
Yes. I think the edge boils down to two things. One is access and two is value creation. And it obviously connects very tightly. If you go to a company, to a very good company, I mean, investors are lining up. They have 50 million they want to raise, but they have demand for 100. So who do I give that capital to? Of course, I will select my dearest financial big ticket investor who leads the round, sets a hefty valuation. But then I will think about, okay, who else do I want to have on the boat? And then if you're an easy to deal with corporation that comes along with a relatively small ticket, but with a lot of promising value creation potential, then the access into that round, and look at some of the logos we have recently invested from Lovable, N8N, ElevenLabs, Black Forest Labs, so very, very strong logos. They take our money because we help them do more business. And that's the second part of it. You need to live up to your promises. It's not enough to just say, we're Deutsche Telekom, there's so much business, come on, let me in. But you have to constantly over the years show that you're actually living up to what you're saying. It doesn't mean that everything that you plan works out, but they need to understand, hey, we're doing everything to provide business to you, and here are the success stories. Well, here are some elements that didn't work out. That's perfectly fine, but speak to the other CEOs. If they speak good about us, then we have made our job right. And through that, you're a value accretive investor that everyone wants to have on the boat, which then develops into the nice position that if the big financial investors have an asset that they really like, and they want to bring on some strategics, you're one of the first they call. So that's what I always tell my team, is we need to be the first ones that Andreessen, Sequoia, whoever calls. If they think about, hey, this should be somewhere around telco, tech, Europe, who do I call, right? Okay, let's call T.Capital and ask if this is for them.
The general assumption from the venture capitalists in the ecosystem is that do not take money from the corporate venturing people, right? Because, they have all kind of governance issue. They only stay on for 3.7 years and so forth. And you say, you want to be the first ones that the Sequoias of the world call, right? How have you gone about this, and are you fighting this in the ecosystem, or how do you see it?
So we're not fighting. We're the friendly guys. So, if someone doesn't want us, then it's not for us. There's no point in fighting. It's the point in showing that when we come on board, it makes sense for everyone. So this means, as I said, you need to be easy to deal with. No one wants to have a complicated corporation that is slow and makes weird demands, doesn't understand the game. So you just need to make sure that you are as market standard as possible and as quick as allows. Right? And that's something where you just need to manage your own processes, structures, stakeholders, right? We've done that very well.
As a corporate venture capitalist, right, it's also you try to find this value creation that you give to the portfolio companies. Is that something that you map out as you go through and prepare your investment proposal to your IC? How do you work with this? And do you have like a 100-day plan following your initial investment where you go through this?
It depends on the case, obviously. There's investments that are very explorative in nature, where you want to learn something for the organization, up until that you have a very concrete value creation plan with like revenue targets. The important part for us is every investment that we're doing has a business owner from within Deutsche Telekom. So we always have the person who is responsible then also to deliver that partnership. He's part of the investment process. He comes with us to the investment committee and explains why this is strategically relevant for Deutsche Telekom, why this makes sense for Deutsche Telekom, how these investments help him achieve his commercial objectives better than without an investment. And that has proven to be very, very effective. And then also to instill that discipline in the organization, because the business owner might be there for 2 years and then he gets promoted and someone else takes over, that you make sure that not only the person, but also the role within the organization. This is one of their tasks. And if the person leaves, then the successor needs to pick that up. And it's you have to prevent not invented here syndrome. But again, this is part of also the collective organizational memory, which is for us easy because we're doing it for a long time. But if you're starting a CVC pretty new, it's good to write such things down and commit everyone on a script or a rule set for you as an organization, how you want to carry this out in order to be able to make a typical venture life cycle of 7, 10, 12 years and not the typical CEO tenure of roughly around 3.7 years as well.
And is it something that you basically track with your portfolio companies to evaluate, where do you need to spend your time? Where can you do a difference in value creation? Is that something you do on a regular basis, or what is your view on this?
Yes. So every company has, we have a small team whose only job is to look after the business relationship between Deutsche Telekom and the portfolio companies. And then they obviously do whatever is needed. If this is a high intensity, here's monthly jour fixes, here's hand holding, here's really doing that. If the business runs basically by itself, okay, here's a biannual check-in just to count the money that we've been making, and everything in between. We have a pretty sizable portfolio, so also you need to steer the resources where they make the most benefit. It's important to help the companies and the organization, because you're still marrying the corporate world of a very big corporation with a very young company, which if you've seen it 10, 20 times, it helps if you take people by the hand. It's like, this is okay, let's do it like that. Yes, they need that. I know it's a pain, but it's worth it. Or also saying them, look, it's not worth it. Right? That's also the job. If you're like the company, if you also have to tell them sometimes, okay, let's park that for a year. You're not ready yet, or the organization is not ready yet. Let's revisit in time. Because at the end, the most limited resource that we all have is time.
And I think that ties really nicely into what you said a while ago, right? That you need a little bit more mature companies to work with the big corporates to make it successful, right? And it is okay to do an investment, before they're actually ready, right? Because you can see the promise in it.
Oliver, I would love to ask you about this second one, which is that you must have the right playing field selected and it must match the corporate you invest for. I think we've spoken on this podcast, on the corporate podcast, a lot about how you as a CVC, meaning the venture investors, do this and kind of the rule book for the people that are running the CVC. If we flip this question to the people that are in the corporate, so to say, and are devising what this CVC should look like in the beginning, what would you say that the mothership should be looking internally for to know that we are ready for this, we can do this? Because yes, it's right that you as a CVC leader need to pick the stage that's right, and you design it around that. You design your strategy so that you get the right ownership amounts compared to the value add that you bring and the competitiveness of the market and all these things. But as a corporate, to be able to set this up, what are the things that you must be able to look yourself in the eye and say, yes, this and that, we completely live up to?
Yes, absolutely. I would start with the team. What's the kind of team that you have available or want to bring on board? If you have a seasoned vice president of M&A who now does ventures, he needs different support than if you have a young associate from a venture firm that you now give an opportunity to build up a CVC. So for example, if I have a very young and unexperienced team, maybe I don't ask them to do very big tickets investments from day one, but first I ask them to do some investments into other funds, just to build their network, get smart about everything, get curated deal flow from the funds that you've invested, and then grow into taking more risks through direct investing. If I have a very seasoned team, maybe they don't need that. So they need maybe then more support of how do I make my structure internally for decision processes. If they are in very fast-moving deals, how do I make sure that within let's say, a lead time of 5 days. I come to a conclusion about an investment of 5 million, which, for example, I see in some corporations, every venture investment goes to the board. That's very difficult because boards are very busy to get the timing right. We have an investment committee where senior executives from Deutsche Telekom are present, but it's not the board. So those are people that, if it's important, we can get them together at 11 in the night. Hey, we need to discuss this. Let's discuss this. Let's come to a decision. So if you have the team right, you need to structure your processes right. And then lastly, steer them to the right direction. I mean, everyone has their home turf or things that he's interested in, which hopefully overlaps, but not necessarily reflects everything that the corporation needs to be interested in. And that's then more on the corporate side, or together work out what are the focus areas? What are the areas where I really want to instill innovation? AI is a very obvious one, and we did a lot of AI investments because there was also a top-down driven mandate from the organization. But then also if you go beyond in telco, it's a lot about cybersecurity, IoT, and cloud, because those are growth areas where a lot of technology changes are happening. So give them a bit of guidance on which areas to focus on, because if sometimes corporate venture teams get lost in boiling this ocean, especially if they're small teams like 2, 3, 4 people, and then you expect them to cover the wealth of your very large organization, that overwhelms it. So give them some guidance and areas to focus on and then build from there, and not just throw things at them and they need to become an expert in everything on day one.
But I think for me, it also listens to, some of my own viewpoints, right? You need to understand the culture of what you're going into as a corporate, right? Do you embrace this innovation that is external and the not invented here syndrome? And then when I listen to your energy, Oliver, it's also, you must spend a lot of time on stakeholder management to get where you are and do what you do. Could you talk a little bit, just about that? How do you spend your time?
Absolutely. And I mean, there's 2 elements to that. One is obviously the structural. So do I have the right bodies, the right little fixes, the right rounds being set up? It's very good to think about and also to revisit constantly. I remember a time where we had 9 people in the investment committee. Now we have 5. 5 is better than 9 in my opinion. But how do we make sure that they cover the broader organization? We have something called the expert group, where we then have business owner, not with making decisions on that, but just have to have a forum to exchange around what's important for the corporation. So really think about how to set up the right structure of forums or bodies that you need so that you can act quickly, but at the same time cover a lot of ground. And 2, it's very interpersonal. People need to like you, to respect you, to understand that if you go to them, well, it's worth my time picking that because A, I'm not wasting his time by just throwing 100 companies to him, but I made a lot of the work already thinking about and diligencing if something is good. And then I come with the top company that I know should be interesting for the business owner. And look, this is great. Can you have a look? Let me know your opinion. How can we do great things together here? And then if you have that trust and that relationship built up over time with the business owner, that's very helpful. And that's a constant process because business owners, as I said, they get promoted, they go elsewhere, they retire. So you have a constant development of finding new people, new internal champions, making them work together with you. But if you find the right people, they all share the same motivation. This is great, working with young companies, doing new stuff.
I'm going to ask you to round this conversation off a difficult question. If you should comment on the state of corporate venture and venture in Europe, do you think that we're in a spot where it works seamlessly well together and our corporates are getting better and better every day and we have a lot of great success? Or do you think we're at a spot where, no, we need to have a serious conversation about how we're doing corporate venturing in Europe, and the VCs also need to have a serious conversation about how they engage with corporate venture?
That's tricky, especially if you want to answer it like on the broad average. But what I see is many projects spinning up and failing. Those are the 3.7 years that you always quote, where you didn't get things right. So I think we can do much better as an industry in just sticking to what works and implementing it throughout corporations. If you have the benefit of 15 years in the industry, it's not that difficult to make the right decisions and the right steps. But you will always have, let's say, centripetal forces that will sometimes bring people to not go for the model that's best for the corporation. So you need to really think as a corporation around, hey, what do I want to achieve? How can I retain my talent, retain my great team, but also make sure that they still invest into the areas that matter to me and have strategic merit top of their mind. I think that's something I said. Some are doing that very well, not only us, but also many, many others. And there's many models which were coming and going where it didn't work out that well. If you then look to the VC industry, I think this is under-levered as well. But this, I think, boils down to the lack of patience or sometimes also lack of necessity for venture firms to do this. If they have enough investors, working with a corporation, there's a corporate tax, we always call it, right? You need to spend time and effort with them. You need to educate people. They want more than just returns. Some leverage that very well and create this ecosystem of value accretive investors and partners around that. Some tell you about it, but then you don't never hear, after wiring the check, you never hear back from them, right? So also there, I think for a corporation, again, pick the funds that you want to invest into, understand, reference them if they are really set up to working with corporations. And as a VC firm, I think there's nothing to blame on them, right? It's their job to raise capital, and they will raise capital where they get it from and where the effort is least. That's entirely rational.
Oliver, you've said a couple of times that it's difficult to say things on the average. I think it's kind of like with venture as well, like normal venture, that this is a bit of a power law driven industry. And in other words, you have some people that do it exceptionally well, but if you look at it on the average, it's maybe not that exciting of an asset class. And I think we can say a bit the same thing with corporate venturing, that at least the CVC part, that it can be absolutely beautiful if you get everything right, but it is difficult. And it's not everyone that's cut out for it. And for that reason, on the average, it might not look that great. But if you know exactly what are the dials, and I think that that's what you've mapped out quite well here, if you know the dials and where you need to tune them to, then it can be an incredibly powerful instrument. But you also need to be ready to, from the get-go, acknowledge this is not for us. If we do this and force it onto us because we think we need innovation, then we will probably end up with something that is less than optimal. And then it's better to stay out of it entirely from the beginning. Is there some truth to that?
That's true, and it also returns to what I said initially. Be clear about what you want to achieve, and great can mean different things to different corporations. Maybe you just want to set up a small VC firm that supports local startups around your headquarters. That's great, right? If that's your objective, then do the best out of that. Be the best local seed investor for local startups. Great. If you want to be, hey, I need to innovate my entire technology stack and I need to drive this in the US and Europe and Israel, well, then you have a different playbook, right? But once you're clear on what you want to accomplish, then you can set up the model in the right way. Do you need to have R&D access? Well, that's different. I need to go to the universities. I need to go early stage founders. Do you want to have go-to-market partnerships? Or later stage, let's go to someone who's really where I can bring my distribution power to. So that's sometimes what I lack of cooperation, this clarity on what this entity is for, other than, yes, I'm also doing venture. It's great and I have something to talk about. No, be very clear about what you want to accomplish.
I think it was an awesome ending on where we are and where we need to go and how to do it. So for me, that was a perfect wrap-up. And I'm really impressed, Oliver. I think you have done an amazing job at T.Capital to get it where it is today. So thank you so much for sharing.
Thank you for having me.
Of course, anytime. Thank you, both of you. Thank you, everyone who tuned in today. I am really hopeful that you'll all be more and more engaged with the venture community, because we truly need the corporates and the VCs working more closely together. Thank you all.